Do you see a problem with the US corporate bond market at all, given the way yields have moved?
So if we talk about places where there has been excessive growth in credit, in aggregate, you can't point to the United States of America. I think everybody, though, who covers financial markets realizes that there is a section of credit within America, which is junk, which has once again been growing pretty quickly. Whether there's a significant enough catalyst to undermine cash flows to create a problem there, I think we just have to wait and see. There's a significant boost to US cash flows going on through the cut in the tax rate. And that bit of the credit market that looks susceptible, because it's just been, it's high risk credit, does have this advantage of lower tax rates. So I think on that one, the jury is out. I don't have a very strong view on US high yielding credit. It seems like an accident waiting to happen, but I don't see the catalyst for it happening. The problem, I think, is the discrepancy actually between that debt and emerging market debt. So we have a pretty significant sell-off in emerging market debt, and really it's fairly moderate in American high yield debt. And I think that causes great problems for the world, because the Federal Reserve, I think, is much more interested in its own high yield market than it is in emerging market debt. And I think twice in the last 5 years, the Fed has changed its monetary policy to help emerging markets. Once in the middle of the taper tantrum, when I think it was less aggressive than it otherwise would have been. And secondly, first quarter of 2016, when there was real distress in the commodities markets, I think the Fed backed away. And I think what's really important is this speech that Jay Powell made in Zurich last Tuesday, where he said that the Fed did not believe it bore any responsibility for capital inflows and capital outflows out of emerging markets. So if we have this discrepancy with US high yields seemingly stable, no issues with credit in America, but meanwhile, real credit issues building up in emerging markets. So that high yield debt market is really interesting. And it might sound like, well, if it begins to crack, we should be worried. But actually, if it begins to stay stable and doesn't crack, there's another reason to be worried, which is that Powell continues on his tightening track, regardless of the pain developing in select emerging markets.
But what's the path of least resistance for the US bond deal now? Is it 3.5% or 2.5%?
It is amusing to me that everyone's become an expert on the US bond yield since it got through the magical number of 3%. Suddenly, everybody's grandmother is an expert on the US bond market. And when you begin with a price and forecast backwards, I'm always kind of wary about that. I mean, I'm not saying that the fundamentals always help you, but it is good to start with the fundamentals and then go to the price. So my view is that we're quite close to the peak on the US bond yield, that it's an incredibly attractive level for many investors all over the planet, obviously mainly due to the incredibly low level of yields in Japan and in the Eurozone, and therefore it will begin to attract investment. That obviously is helped by the view that I don't think inflation is a problem. So I think most people look at the 3% yield and think, well, it's just reflecting a tight labour market and the inevitable rise of inflation. So for that yield to peak and begin to come down again, I think we are going to have to see some data which makes people question their outlook for US inflation. Or a credit event, and in any credit event, there is a flock to the world's most liquid asset. And United States Treasuries retain that position. We can go back through credit event after credit event, but if there's a sizable one anywhere in the world, Treasury prices will be bid up, not bid down. And the more we gear down our expectations for emerging market growth, then the more we look to lower inflation. So I think we're close to a peak. Despite the numbers I've just given you for this excessively large supply of treasuries. And I think one of the reasons the dollar is going up is that foreigners are finding it very attractive. If I tell you there's a country that's issuing a lot of debt, you might think, well, we'll have to sell US equities to buy all that debt. That's possible, but it's also possible that we sell German equities or Japanese bonds. And the fact that the dollar's going up does suggest quite a lot of capital coming into the US, and that 3% yield is proving attractive, particularly for foreign investors.
Do you have a view on the dollar? Do you see it strengthening further?
I do see it strengthening further. Everything I've said so far would suggest a strong dollar. As you know, exchange rate forecasting is probably the most difficult thing of all. They're the big, liquid, deep markets. But there are rare occasions when the dollar becomes really quite forecastable, and it is a credit event. It's a situation where the world starts to de-gear. In a world of rising gearing, what happens is many people in the world tend to borrow dollars. Now, they may use that to fund investments in India. They may use it to fund construction projects in Turkey. They may use it right across the emerging markets. But when we have a credit issue, when credit becomes less available, or people wish to repay it to reduce the risk, the net position is a buying of the dollar as people move back and pay off those liabilities. So if we are looking at Turkey, I think going into de facto default through the imposition of exchange controls, I think we're looking at a de-gearing event. It'd be very, very rare for the dollar to go down in that scenario. And then just once again to refer back to Jay Powell, he did make a very clear statement that if these things begin to happen, it's none of his business. Now, if he continues with that, the dollar could go very high, very sharply higher indeed. The two other major currencies in the world, I think, have unique problems. Japan has a unique problem that it has no savings left to fund its government, so its central bank is, and over the long term, that's always been bad for exchange rates. And in Europe, we obviously still have this problem that the fiscal integration / political integration of Europe has really hit a roadblock. And it's difficult to see how a single currency functions unless progress can be made on that integration. And yet, Italy is the latest poster child. It seems that the people are voting to go a different direction, away from integration, towards greater independence and sovereignty. It's very difficult to be bullish on the euro. So the dollar almost by default because of what's happening in the other two, but specifically because of a credit event, it has always spiked the dollar higher.
Where does this leave emerging markets? Because usually the two move in opposite directions.
Yeah, I mean, it is really sad that they're lumped together, I should say that. I mean, the fact that policymakers in Turkey have made some dreadful, dreadful mistakes, why should that have any impact whatsoever on India, China, or anywhere else? Unfortunately, it does because the capital flows are lumped together. So, for instance, there are lots of emerging market bond funds and emerging market equity funds. And if they start getting redemptions, then it is kind of pulled pro rata almost from all of emerging markets. So emerging market risk has been pushed down to very low levels. I think Jay Powell is wrong. I think it's been pushed to very low levels by his monetary policy, by the fact that US interest rates are so low. So I think for all emerging markets, we'll see the risk premium reset. I know you're going to ask me about India in this context, but the ones where there should be the massive reset are the ones where the politics are really just completely in the wrong place. And I would pick out Turkey, but there's lots of others like the Philippines, like Hungary, I would say even potentially Poland. There's a big election coming up in Mexico in October, and politics could go completely to the wrong place. And what I mean is the kind of old politics of more control, restrictions on markets. That's the dangerous populism for investors. Now, I don't see any of that in India, and I realize people watching may have a different opinion. But I see the current political setting in India, even if growth slowed, I don't see the current political setting being pushed off course. And this is going to be a very, very important test now for all emerging markets. How do you respond if there is another downdraft? And I think the politics of India are such that it will pretty much keep to the same track. But there are other places in the world that would probably go a different direction.